Are you familiar with liquidity? And if you are, is that even something that is important? Well, if that concerns you and you have some questions, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. One of the things that you'll learn about me really quick is that liquidity is quite important. Just what is liquidity? Well, liquidity is essential when owning an asset such as stocks. In a nutshell, it's the ability to get in and get out quickly so that you can take an asset and turn it into cash, or take cash and put it into an asset just as fast as possible. The faster that you can do that, the more liquidity you have. So when we're looking at the stock market, liquidity is something that we really need to pay attention to, but a lot of times people really overlook this. For example, you might have an asset that's worth $20 million. Let's say it's a piece of art, or you have a building or a chunk of property or something that you were able to get a value of $20 million placed on that asset. If you tried to sell that asset, could you do it quickly? Could you take a $20 million asset and turn it into cash in a matter of minutes? Or would that take weeks, months, or possibly even years for that to happen? If not, how valuable is that asset? If you have something that's worth $20 million and you need some money and you can't turn that into cash, how valuable is that asset to you? Now, I'm discounting any sentimental value, or maybe it's something that you've inherited or something that you've spent your whole life building up. I'm just talking about an asset that can be turned into cash, or cash that can be put into an asset without any other considerations for what's happening here. Just pure liquidity. When you have an asset that's worth a whole lot of money, at least on paper, the first thing you have to do is find a buyer. Then it can take a long time to complete the transaction. It may be necessary to hire a broker or some kind of an agent to try to find a buyer for you. I don't know about you, but I don't have too many friends that have a $20 million piece of artwork in their house, let alone a piece of artwork that they're trying to sell. So finding the right kind of people just to purchase this type of asset might take someone where their specialty is uncovering these type of people, and then you're going to have to pay them a chunk of change too for helping the transaction to be completed. Something that you thought might be pretty simple when you said, well, we better sell that picture of Aunt Louise that's been hanging on the wall. We know it's worth a lot of money, but we really need the money right now, so we better sell it. So you made your decision. Now comes the whole complicated process of completing that transaction. Liquidity allows you to buy or sell something quickly. That's a real important aspect when you're talking about the stock market, and there's even liquidity in the stock market that we need to look at, because some things are very liquid while other things are not. So let's talk a little bit about liquidity in the stock market. One of the great things about the stock market is there's been a tremendous increase in daily volume over the last couple of decades. When I first started out, trading was good, and I liked that, and I could get in and I could get out quickly. It has gone way beyond that now. One of the nice things about the stock market is it's one of the few things in life where the more people participate, the more advantageous it is for everybody? Because if you see a lot of volume, that means you can get in and get out quickly. If you don't see much volume, it could take a long time for that transaction to be completed. So we like real strong volume. We like the fact that volume is going up year after year after year. Just as an example, I'll give you a bit of a benchmark based on my experience. I started in the early to mid 1990s. When I was really starting to look at the stock market and really studying it and trying to understand what it was all about, it would be typical to see anywhere from 300 to 400 million shares traded that day on the NYSE. That would be a good, strong, healthy day. And there's a story that I tell. Right about this time, I was living in Florida, and my father came down to watch some spring training games, and we were watching the TV as the market was getting ready to close, and they came on and said, we had over 400 million shares traded today, and my father made the comment, wow, I've never seen a 400 million share trading day. That was the first time for him. Now, it had already happened before that, but this was the first time that he actually saw that happen. Currently, a slow day on the NYSE is considered to be anything under 1 billion shares. We've gone up 3 to 4 times in the amount of volume that we see each day than what we saw just in the early to mid 1990s. That works to our benefit, and I'll go through and explain a little bit of what I mean by that. That means that a lot of investors are trading every day. Duh, you think? Yes, there are lots of traders out there. We're seeing more volume now than we ever have in history, and it should just continue to go up. So this volume consists of institutions, banks, hedge funds, yes, individual investors, but that just makes up a small percentage of the overall daily volume, and so on. There are people within the U.S. that are trading in the market. There are people outside of the U.S. that are trading in the U.S. stock market. The volume just continues to grow and grow. It's estimated that anywhere from 60 to 90% of the volume each day is computer driven. It's not even a real person doing this. There are people that take a computer, they have some kind of secret algorithm that they come up with, they program these parameters into the computer, and when A plus B equals C, boom, the computer buys. Or when X plus Y equals Z, they sell. There's no emotion in it at all. They're just a bunch of trading rules. That's why we can watch these things going on, because these rules are kind of easy to figure out sometimes. And that's what I do each day when I analyze the market and then prepare a video. But typically about 60% on any given day is computer driven. When we have really rip-roaring days to the upside or to the downside, the overall volume can get up as high as 90% of all of the trading volume. Let's look at some famous high volume days that maybe you've heard about if you've studied history a little bit or if you have an interest in this sort of thing. The 1929 stock market crash, which is generally considered to be the defining moment that started the Great Depression of the 1930s, and then we would eventually get out of that when we entered into World War II. The stock market crashed over a period of 5 days in 1929. The first sign of trouble was on Black Tuesday, October 24th, 1929. You notice that a lot of these things happen in October. That's why a lot of people get real leery come the mid to latter part of October. The volume on the stock exchange was around 4 million shares each trading day. Now that would be considered low volume, ultra low volume today. Even a stock that doesn't trade 4 million shares is considered a low volume stock. But this was in 1929. On Black Tuesday, a record 12.9, almost 13 million shares were exchanged on that day. That's the famous day that you see the pictures of. It's very common now for companies like Google, Amazon, Microsoft. They'll trade 3 times this in one day. This was considered to be very, very high volume for that time. Let's also look at the 1987 stock market crash. 595 million shares were traded on that day of the crash. Remember when I said a billion shares is considered to be a slow day now? It was roughly half of that in 1987. This overwhelmed the systems that were in place at that time and prevented many investors from being able to sell. I've heard stories and I've actually talked to people who were brokers during that time. They just unplugged their phones. People were calling them and saying, sell my stock, sell my stock. The broker couldn't do anything about it. If he could even get through to try to make a transaction to sell, a lot of times it may have just gone unnoticed. So they just unplugged their phones because there was absolutely nothing they could do about it. After that, there were a lot of reforms and they really beefed up the technology. And you notice 1987? Well, in 1989 was when we had the birth of the internet. That's when HTML was created, and then the whole growth through the 90s. And that has benefited us, not only from the information that we receive, but in the technology that we have behind us when we go to invest in the stock market. One of the things that you'll also learn from me is that I don't really look at point values, whether the Dow was up 1,000 points or down 1,000 points. I don't care about that. What I'm concerned with is percentage days. How much of a percent was the Dow up or down? Because if you're up 1,000 points and the Dow is at 5,000, that's a lot more than if the Dow's at 20,000. So just do the math and you'll see that it just doesn't have as much of an impact. But people like to stick with little numbers, especially the financial media. And they get hung up on that when it's really not telling you anything. Let's look at the 1929 stock market crash from the perspective of percentages. In late October of 1929, the stock market crashed over several days, wiping out 40% of the paper values of common stock. Common stock are typically what trades on the stock exchange. 40%. So if you had a portfolio that was worth $10,000 over a period of several days, it was now worth $6,000. 40% of that just evaporated. Then in the 1987 stock market crash, on October 19th, 1987, a day that has become known as Black Monday, the stock market crashed as the Dow plunged 508 points. I mean, that's a yawner today. Or at that time, that was 22.6%. That is a huge move in one day. For us to see 1, 2, 3% moves now is kind of a big deal in one day. We often make note of that and even mention that. But to see almost a 23% move in one day, that is gargantuan. Its largest single day percentage drop. We haven't had that since then. We came close in 2020, and I'll talk about that. The crash came after a 2-week period in which the Dow had already dropped 15%. So you lost 23% in one day. Well, before that, you had already lost 15%. So we're looking at some pretty hefty losses here. Then we have the 2020 COVID-19 outbreak. On March 16th of 2020, the Dow lost 12.9% in one day. Not as big as in 1987, but still, the Dow lost almost 13% in one day. Between February 19th, when the whole COVID panic and the COVID plunge that we talk about, when all of that started, until March 19th, about 3 days after this almost 13% loss, the Dow shed over 35% of its value. And if you look at a chart, we just crashed. We call that the COVID plunge now, mainly because of the big V shape that we have coming up out of that. And so far, the stock market has held up pretty well since we saw that big COVID plunge. Where it's going to go in the future is still under debate and very uncertain at this time. So only using numbers can be misleading. I talked about that just a second ago. I don't like doing that. Now, there's sometimes when you have to pay attention to numbers, especially if you trade options. There's things called strike prices that we have to pay attention to. But if I say the Dow's up 1,000 points, it's down 1,000 points, that doesn't tell me anything. When discussing significant up or down days, the media often makes at least 2 mistakes in order to make things sound more dramatic. Remember what the media is trying to do. They're trying to get your attention, they're trying to shock you, and they're trying to have you go, oh my gosh, the world's coming to an end. Oh, what are we going to do? It's their job to suck you in to what they're trying to say. So the first mistake that they often make is the gain or loss is reported as numbers when the vital factor should be percentage gain or loss. A lot of times I can't even tell you how much the S&P is up or down as far as points. I'm always looking at the percentages. That's what I key in on all the time. The focus is on the Dow, which again is another mistake because that's 30 stocks. And it doesn't necessarily represent the US stock market, where a better focus would be on the S&P 500 or the SPX. That's 505 stocks. And you get about 80% of the stock market value in the S&P 500. That's one of the reasons I pay much more attention to the S&P. Another mistake that they make, which is also worth mentioning, is when the media says something like this: "We've not been at this level since 1984. I just made that up. That really just bothers me. When they talk about an economic report, "We haven't seen these numbers since 2006. Or "We haven't seen this since 1942. It's like, who cares? That means nothing. There's absolutely no context that's being given to you. Why do they even waste their time saying that? But yet they do. It's something that they can easily report. They can look at a chart and go, yeah, we were back here, 25 years ago. Well, we'll just tell the people that, and they'll latch onto that thinking that they've now learned something when really they've been told nothing. So the statement is true. They're not lying to you when they say these things, but the context can be misleading. What was happening in 1994? Well, we were going down at that time. I'm just making this up. And then we get back to this level and we're going up now. So we were in a downtrend when we saw this level before, but now we're in an uptrend. The context is completely different. And yes, they like to do this. They think it provides some kind of wisdom to you when really it just doesn't. There are times, however, as I mentioned at the beginning of this slide, when investors should pay close attention to the numbers, such as when implementing strategy that are numbers based. This can be strike prices for options. So if you're looking at options that are at the 1,000 strike or the 1,100 strike or the 55 strike or the 42.5 strike, you have to pay attention to those, because as the market goes up and down, that will influence your overall option position. If you don't trade options, you don't have to worry about that. But a lot of you that listen to this do trade options, and so you do need to pay attention to those things. Then liquidity in the program that I teach. The program that I do teach is called the SPX Investing Program. Can you guess what I focus on? I focus on the S&P 500. That's all I do. I'll give you the biggest reason why this program was developed the way it was over 25 years ago. The liquidity of the S&P 500 was the main reason for developing the programs that I teach. It has to do with the ability to get in and get out, not only S&P 500 mutual funds and ETFs, but also S&P 500 options based on ETFs and the index itself. They're very liquid. The SPY, which is the ETF that covers the S&P 500, and if you have a question about that, I have a video that talks about ETFs or exchange traded funds. And there are other ETFs and options that are based on the S&P 500 that are very liquid. And this was the deciding factor for me. Some of the strategies that I teach can be kind of complicated. And if you have 3 wheels on your car that are going in the right direction, but one wheel is stopped, you're not going anywhere. And if you have 4 options set up in a strategy that you're doing and you're trying to unwind that or initiate that, and one of those options is bogging you down, you're not going to get filled. Or you're not going to get out. We can never eliminate that completely, but we can do what we can to take care of that by focusing on the S&P 500, because the options and ETFs are the most liquid out there. This allows for strategies, both simple and complex, to be filled at tighter bid-ask spreads. I have another video that talks about bid-ask spreads and understanding the bid price and the ask price. I would really recommend that you watch that video if you don't really understand those things. It plays a huge role in the market. What we want is as small of price as possible between the buy price and the sell price, so we don't have a lot of slippage when we're getting in or getting out of these positions. The S&P 500 helps us to eliminate or at least reduce those. Techniques and strategies that are taught by the program that I teach can be easily transferred to other liquid markets. I teach about the S&P 500, but you could take the same things that I teach in that program and apply them to the DJX, which is the Dow. It has its own ETF called the Diamonds, or DIA. There's also the NASDAQ 100, or the QQQs. They have very liquid options. They're not as good as the S&P 500, and they're not as robust as far as liquidity, but you can still apply what you learn in this program, then adapt it to other programs. When I first started off designing this program, I was going to call it the ETF investing strategy. And I thought, I was going to teach about the Dow, the NASDAQ 100, and the SPY together. But the more I studied the Dow and the more experience I had with it, I went, forget it. Why do I need to go anywhere else? I'm just going to stay with the S&P 500. It has everything I need and want and more opportunities than I'll ever be able to take advantage of. So I just stuck with that, and that's the basis of the program that I teach. So thank you very much for taking the time to watch this. I really appreciate that. Please click a like or dislike below. Please leave any comments, either positive or negative. Consider subscribing to this channel. It'll really help things grow. Please access the free workshop that I talked about at the beginning of this video. And there is a public Facebook group that anybody can join as long as you're nice. And I do have a blog. It's spxinvestingblog.com, where I have written articles that cover what I talk about in these videos. So thank you very much, and I'll talk to you in the next video.